Hello everyone, my name is Marilena and I will be your hostess for today. Together with me I have Peter, our senior market analyst at IronFX. Hello Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals that are driving the markets currently. So Peter, are the markets still in a shock?
Well, actually, the markets seem to have started to recover. At least there are some early signs of stabilization, at least in the Asian and early European session. But I would like to see how the American session opens to draw more conclusive results out of it.
Okay. And how did all of this start?
Well, the actual, I wouldn't say a crash, but still this high volatility and worry about the US economy started on Friday in the American session at the start, as we had practically the release of the US CPI rates for May. And everybody was expecting that there would be some sort of a peak in the US inflation rates. That didn't. They actually accelerated even further. And that instigated worries for the market that the Fed would start tightening its monetary policy at a faster pace. That because practically, if you recall, 10 days ago we had also very, very robust employment data for May, for the same month. So practically on both fronts of the Fed's mandate, to promote maximum employment and to keep inflation under control, we have on both fronts results which tend to satisfy the needs for the Fed to continue hiking rates, even expedite the pace of its rate hikes.
Okay, and what's on the calendar today?
Well, we had already the UK employment data for April. The next, which is actually right now, would be Germany's CEF indicators for June. Should they show an improvement, we may see practically a more positive picture being formed for the euro, given that current conditions, practically conditions on the ground for the German economy, which is the largest economy in the eurozone, have started to improve. Also, more possibly, the outlook for the next 6 months for the German economy would be improving. The next release, which I would be highlighting, would be the US PPI rates. Now, despite the CPI rates of the US already out for May and showed an acceleration, we would like to see how much depth there is in the rise of prices. And should the PPI rates, producer prices, also accelerate to the higher, then we may see practically the US dollar getting some further support, as that could intensify market worries for inflationary pressures within the US economy. The next release would be for oil traders, and that would be practically just before the Asian session starts. From the US, we get the weekly AP crude oil inventories figure. There was a substantial buildup of US oil inventories up to 1.8 million barrels last week. Should there be another substantial buildup of inventories, that could have a detrimental effect on oil prices. And during tomorrow's Asian session, we have New Zealand's GDP rate, we have from Japan the machinery orders growth rate, and we highlight especially the industrial output growth rate of China. That's for the month of May. Aussie traders will be focusing directly on it, given that we have worries, extensive worries about the Chinese economy as new lockdown measures have started to be imposed. So that's a big issue, as the Australian economy practically exports a high amount of raw materials to China.
Okay. What is expected to be the outlook for the US stock markets?
For the time being, it's still bearish. There was some correction in the European session for the main indexes, at least some stabilization, but it did not seem to affect that much the bearish outlook. We would like to see once again how the US session, the American session, will be starting. Should the cautious sentiment of the market be continued, we may see US stock markets dropping even further. On the flip side, should there be an improved market sentiment, we may see some stabilization and even a correction higher.
How about the USD?
Well, the US dollar got considerable support practically since Friday with the release of the US CPI rates. We tend to maintain a bullish outlook. Safe haven flows are expected to continue to roll in, given also that we have the Fed's interest rate decision tomorrow. So overall, a bullish outlook seems to be still standing.
So moving across the pond, how is the GBP behaving?
The pound had some interesting releases. I would be highlighting, we had the GDP rates yesterday for April. We had also the employment data for April. But the main release which made a sensation was the GDP rate yesterday. It showed that despite expectations for an improvement of the GDP growth rate, actually the GDP growth rate declined deeper into the negatives. That was practically a very harsh reminder of the shrinking of the UK economy. It should be noted that the decline into the negatives of the GDP rate was also accompanied by a further decline of the manufacturing output growth rate, also into the negatives. So overall, the outlook for the UK economy remains rather dark, given that on Thursday we have also BOE's interest rate decision, which is expected to hike rates once again. At the same time, on a more fundamental level, we would be highlighting the possibility of further tensions of the UK with the EU, given that the UK may consider actually breaking or overriding, if you prefer, the Northern Ireland Protocol, which could create frictions and escalate tensions in their relationships with the EU. Actually, the UK economy right now, the last thing it needs is a trade war with the EU. So overall, the outlook for the pound seems to remain rather bearish. It was characteristic that the pound retreated not only against the US dollar, but also against the euro yesterday. So it was a wider weakening of the pound.
And the euro?
Well, the euro, they have the 7 indicators for today, which are expected to improve, hopefully. But nevertheless, there's quite a high degree of uncertainty, especially about the ECB, as we have a bank which is about to hike rates in July and September, maybe with the September meeting delivering a more intense, a higher interest rate hike. We would like to see, though, the whole situation, how it plays out, especially given that in the fundamentals of the euro, we have the war in Ukraine.
Okay, any final comments, Peter?
Well, as a final comment, I would be highlighting once again the situation with China. I would be highlighting also gold. Gold's price, which more or less got some support as a hedging instrument on Friday, but yesterday it dropped at around $60. It tumbled actually, and it was a substantial drop which should trouble gold traders.
Okay, great. Thank you, Peter.
Thanks.
And everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation today. We have in front of us gold's daily chart, and the last days have created a mayhem in the markets, and I wouldn't find a more interesting trading instrument than gold. There were many movements, but gold's price was moving like I haven't seen this movement for weeks, I would dare to say. Now, here you can see practically the upward movement, hence the candlestick is green, of gold's price on Friday. Remember, we're on the daily chart. On Monday, there was a steep drop, which we have mentioned also in the fundamentals, of around $60. It was a huge movement. The only comparable movement to the downwards on a daily basis that would be found practically on the 9th of March. So we're talking a movement which has not been repeated for about 3 months. Today it has stabilized, had even some slight bullish tendencies, but that's more stabilization rather than a recovery. Let's drill down to the 4-hour chart. Gold's price initially actually broke the 1870 to the upside. That was on Friday. But on Monday it corrected, if not earlier, let me check. Yep, on Monday it actually corrected steep downwards, breaking once again the 1870, breaking also the 1836. At some point it was even aiming for the 1807, didn't reach that low, and seems to have stabilized during today's Asian session in European. Going to have to make some adjustments here. The first support line now turns into resistance line, definitely. And let's go hunting for another support line. Daily session, daily chart. So we have some here. Let's have a look. Okay. You have a touch here. Another test here. Another test here. Test. Pretty good. And this should be the 17 in green, please. 1761. Okay, let's round it down. 17.60. Touch. 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 Some commotion here. Touch. Touch. Well respected. So let's keep that. Let's readjust. And we'll make a start. $19.03. 1870 becomes the R2. $18.36 becomes the first resistance line. 18.07, the first support line. 17.87. Second support line. And the 1760. Final support line for now. And I'm saying for now because the price action seems to have broken the low boundary of its past sideways movement. Note how gold's price was moving in a sideways motion between the 1836 and the 1870, and that was practically since the 19th of May, almost a month. Now that lower boundary of the sideways motion, the 1836, has been broken to the downside definitely, and has now been turned into resistance line, given that the price action has moved below it. Albeit some could be arguing for a possible stabilization, given also that the RSI indicator remains below the reading of 50. Actually, that's check. Yep, that's closer to 30. We may see practically a bearish sentiment being maintained for the precious metal. If that's the case, we may see Let's have a look here. Sorry. Let's see if we can draw a trend line. Seems about it. We may see the bears actually taking over. For the bearish outlook to continue, we would require, though, the price action to remain below this downward trend line. In such a case, we may see the bears taking over, breaking the 1807, and start aiming for 1787. In the case when the downward trend line is broken, then we would be feeling more safe to switch in favor of a bias for sideways motion. Please note for the gold report, which is a weekly gold report, which is due out later today, and definitely will have far more details both on a fundamental as well as on a technical level. But it was characteristic how the precious metal got support here on Friday. Don't forget that gold is also being used as a hedging instrument against inflation, and since the US CPI rates accelerated more than expected, some support for the precious metal would be expected. It was characteristic how gold's price was on the rise. I wouldn't say parallel, but still at the same time as the US dollar was on the rise. On the other hand, on Monday morning, though, as US yields started to rise substantially, you can see how the precious metal started losing support and drifted lower to reach a low point of minus $6. Nice. Let's have a look at the USD index, the US dollar. Okay. The R1 was broken. This is the daily chart. You can see the intense movement of Friday, Monday, and today. Let's drill down to the 4-hour chart. That's better. Here you go. Readjusted. And we now go hunting practically for the R3. Daily chart. If there is such a movement. Yep. Okay. Monthly? Nope. Didn't see such highs since 2014. Actually, even in 2014, reached that high. Note that this was the prior high level, which was around the 12th to the 13th of May. $103.95 becomes the first support line. 102.75, the second support line. $102.05, the third support line. And let's move to some resistance lines. 105. Is actually being aimed right now. 106. And red, please. 107. Now, given that the price action has a steep upward movement, as long as it remains above the upward trend line, which has been guiding the index since Friday, that should be, since Friday, we maintain a bullish outlook for the USD index. On the other hand, though, I would like to note that the RSI indicator has surpassed clearly above the reading of 70, which on the one hand tends to confirm the bullish sentiment for the index. On the other hand, though, it may also imply that the index has reached overbought levels and may be ripe for correction lower. So the possibility of correcting lower should not take us by surprise. But as long as the price action remains above the upward trend line, we would maintain a bullish outlook for the index, in which case, should it be realized, we may see the index actually breaking above the 105 and start reaching 106, practically new record highs. On the flip side, should the bears take over, I would expect the price action to break the pre-mentioned upward trend line. That would be a first sign of a changing trend. Yet, for a bearish outlook to be established, I would require a clear breaking of the 103.95, the mid-level here at 103.25, and for the index to start aiming for the 102.75. A series of consecutive lower troughs and lower peaks. Nice chart. Let's have a look now at the pound. Yo, that's deep. It's very deep. Yeah, there seems some stabilization in play here, but I wouldn't trust it. Okay, as a first move, let's reverse all the prior support lines to resistance lines. As the price action has broken practically the 1.2470, the 1.2330, the 1.2165, and is hovering just below the 1.2165 for now. And let's start searching for support lines. This show, in my opinion, will be excluded. Okay, let's have a look. Okay, this is a little bit too close to the price action, but let's get a better look here. This one. This would be the 1.2070 for cable. First support line being set. The second and the third support lines are hiding somewhere here. This could widen a bit. Yeah. Okay. The second support line, not much to work with here, but this show was interesting. So let's go at 1817 in green. 1.1817 would be the second support line. And the 1.1637 would be the third, with our last support line being the 1.1445. Actually, we usually work only with 3 support and 3 resistance lines. Let's have a look. Here we go. $116.37 as the third support line, 118.17 as the second support line, 120.70 as the first support line. Pretty tight movement. Maybe this could be moved a little bit to the upwards. We'll have to wait and see on this one. 1.2165. I don't like this. Let's recheck this. $22.10. So the 1.2210 comes our first resistance line. Why? Because this peak here earlier in the European session practically signaled a high. $1.2330. Second resistance line, support here. And also price support line 1.2470 being marked now as a resistance line. Now, given that the price action has actually broken the downward trend line guiding the past Friday, we tend to switch our bearish outlook in favor of a bias for a sideways movement between the 1.2210 and the 1.2070. I would like to note, though, that the RSI indicator remains clearly below the reading of 30. So I wouldn't be surprised to see bearish tendencies once again regaining the initiative. And in that case, should the bears actually take over, we may see the price action breaking the 1.2070 and start aiming for the 1.1817. On the flip side, should I be wrong, as could be the case, we may see the price action reversing direction. And should the bulls take over, we may see cable breaking the 1.2210 and start aiming for the 1.2330. Note how we see the perspective for a downward motion more plausible than an upward, given that the RSI indicator remains below the reading of 30. I would like to note also the possibility of a correction higher, as the pair is still at rather oversold levels, but note how the price action was running along the lower Bollinger Band and has stabilized, so practically there is a gap here, which tends to provide some room for maneuvering for the bears. So we may see the price action breaking below the 1.2070 before stabilizing once again. Quite interesting. Let's have a look at USD JPY. That should be at highs. Oh, it's stabilized. That's nice. And the resistance line seems to be holding. It's a new support line to the upside. Red. It could be higher. Oh, look. That's a record high, people. Since 2002, and our chart doesn't go back that far back. And I don't know how relevant actually a level would be from 2002. Let me readjust the labels as well. 131.50, sorry, 35. 133. 134. 135. Widening it a little bit and moving to 136.5. And finally the 138. Please note that we're at very high levels for USD/JPY. I would dare to say fundamentally that we may be also in the range of prices where the BOJ may be ready to intervene. Some analysts would be highlighting the area above the R1, the 135, as such a possible area. And should the BOJ actually intervene, we may see it intervening in the market in order to defend JPY. So practically would be buying JPYs with hard currency and draining the market out of JPYs. So there would be less supply, in which case we may see USD/JPY dropping as the Japanese currency would be strengthening. For the time being, we tend to maintain a bias for a sideways movement between the 135 and the 134. To the downside, should the bears actually take over, we may see the price action breaking the 134, possibly breaking also the 133 and start aiming for the 131.35. The RSI indicator is just above the reading of 50. There are some downward tendencies though, which should not be neglected. Some stabilization as well. It will be interesting to see how this actually plays out. To the upside, and should the bulls take over, once again, we may see the pair breaking the 135 and start aiming for the 136.50, not maybe even for the 138. Let's have a look now at AUD/USD. Oh, okay, that's interesting. So we had practically a breaking of the 0.7035, the 0.6950. Yep. Reverse this into a red. So there's downward trend line here. Interesting. Let's turn this into a green one. We have to go a little bit hunting here. Okay, let's go back. Drilling down to the 4-hour chart. We'll have to work with the daily chart instead. Okay, there are a few touches here, definitely. This one seems to be out of place. Yeah, this touch. It's a resistance line, but it has also some support motion here. Okay. Into green. 66.10 here. 0.6730. $0.6730 now being placed. $0.6825. R1 being placed at 0.69.5. The R2 being placed at 0.7035. Yep. And the R3 at 0.7155. There we go. So we have a downward movement. Cancel. That's interesting. It seems about to be broken. Stabilization seems to be taking place, but as long as the price action remains below the downward trend line, guiding the pair since the 9th of June, we tend to maintain a bearish outlook for AUD/USD, in which case we may see the pair starting to take aim at the 0.6825 support line. That's the S1. On the flip side, should we see the price action actually breaking the pre-mentioned downward trend line, our initial reaction would be for a sideways motion with the price action revolving around the 0.6950. Should the bulls take over as the first possible target, we would note the 0.7035 with a support touch here, resistance touches here, and support touches here. So it's a level well respected by traders. Even higher, we have price support line here, the 0.7155, which also tends to provide some resistance here as a possible target. To the downside, we note the 0.6825 and even lower the 0.6730. Let's have a look now at US stock markets. How are they behaving? Let's start with the S&P 500. Okay. An intense downward movement, which seems to be holding. That's interesting. So there was a correction in the cards. Okay. Let's switch all the pre-mentioned support lines into resistance lines as they have been broken. The first support line, I would place it here. That would be this 30,735. Let's turn this into green though. The sea of the reds in the US stock markets yesterday. It was unbelievable. Let's have a look for more support lines. Okay. This one looks like a nice touch. Green at 300, 3,600 and even lower. Yeah, see these touches here? And this touches. So I would be keeping this in mind as well. 3,415 color green. Okay, we made some room for the bears here, as the support lines are wider. $3,860. That used to be our final support line. Now it's being turned into the first resistance line. And the S2 becomes the R2. And a final resistance line being placed at 4,075, which used to be a support line. That's it. So we tend to maintain a bearish outlook for the price action of S&P 500 as long as it remains below the downward trend line. I would be highlighting though also that the RSI indicator, despite a correction higher, is still below the reading of 30, which may be underscoring the presence of the bears. Yet that may also imply that the pair is still in oversold levels and could correct higher at any given moment. Should the price action actually break the pre-mentioned downward trend line, that would be instigating a switch initially from a bearish outlook in favor of a sideways movement. However, that would also depend on whether the price action of S&P 500 actually breaks above the 3,860 resistance line and starts aiming for the 3,985, which would be signaling possibly a bullish outlook to the downside. And should the bears maintain control over the index, we would expect the price action to break the 3,735 and start aiming for the 3,600, possibly even breaking it during today's American session and start aiming for the 3,415. Let's have a look at NASDAQ. Oh yeah, a similar picture. And also for Dow Jones. How about WTI? Well, WTI had a drop that was practically on Friday. Note how heavily it dropped. It even opened with a negative gap on Monday morning. Yet during Monday's Asian session, it quickly rebounded on the 118.50. It was interesting, 115.80. It was interesting how this level was well respected by the market, yet has moved consecutively higher and has broken now also the 118.50, returning back to the sideways motion it was between the 118.50 and the 121.30. Once again, So I would expect initially the price action to respect the 121.30 should the bulls maintain control over the commodities price, in which case we may see it start aiming for the 123.90 should the R1 be broken. Let's have a look where this actually rests. So it rests here, nice peak, and the 126.5 practically marks the record high level for the commodities price. We're always talking about WTIs for our chart. To the downside, we note the 118.50, which used to be a support line here, resistance line, resistance line. Lower than that, we note the 115.80, which was actually able to reverse the downward motion of the price action on Monday morning. Also note the support provided here, and the resistance here and here. To the downside, we also note the 113 providing support here and resistance here. And once again, we tend to maintain some slightly bullish tendencies. See how the RSI is above the reading of 50 and still rising. Should that continue, we may see WTI's prices reaching, if not breaching, the 121.30s, thus paving the way for the 123.90. And even higher, we note once again the 126.50. To the downside, we note the 118.50. Note how the price action has broken also above the mid-level of the 20 moving average, which is the mid-level for the Bollinger Bands, and has enough space to move to either direction. For the time being, though, tends to maintain some bullish tendencies. To the downside, we note the 118.50, and even lower than that would be the 115.80, while the lowest level noted would be the 113, which provided support here and here. Some could also possibly discuss a sideways movement between the 121.30 and the 115.80. Note this motion here. Practically, it's a sideways movement here, but the bullish tendencies here should not be underestimated. On the fundamentals for WTI, definitely tight supply is an issue. On the other hand, the possibility of lockdowns in China may drive the price lower. WTI prices could be affected also by today's API crude oil inventories figure, that's for past week, as well as EIA's crude oil inventories figure, which is for QR tomorrow. Interesting chart. From all of us here at IronFX, best wishes for solid trading.
Hello everyone, my name is Emily and welcome to our daily trading tips. So how do you trade economic events? Some days, some events will give the trader a small window to act through, and that's going to be it for the day. For example, if you're trading a specific event like an earnings release or oil market meeting or a political event, you might have a good indication of the result of that event, and that's great. Yet, the market's reaction to this event may have a maximum duration of 30 minutes. Those 30 minutes are more than enough, but you, the trader, will have to be in during that time and get out just in time to make a profit. If you want more time, tough luck. If you want more price action, tough luck. You will have to get whatever the market is willing to give you. Say thank you and move on to your next trade. The market is not what you want. The market just is, and so you will have to be in when it's available and out when it's gone. That's why trading is challenging. And also, guys, something that I've learned through my experience. There is no tomorrow in trading. And what I mean by this is that one thing you should always keep in mind when trading is to keep your focus in the now. Traders should understand that the only moment they will ever have is the now. It's just like the Rocky movie when Apollo said there is no tomorrow. The now increases your capability of receiving opportunities and information that the market offers and reduces your fears and misconceptions. So stay present, keep your mind clear, and observe. Thank you very much, guys.
Yesterday's market action remained worrying, given that the USD was on the rise against its counterparts, while US stock markets continue to drop, with a number of analysts now citing that US stock markets have entered a bear market. It should be noted that the market worries for a possible 75 basis points rate hike of the Fed tomorrow seem to increase, given also that inflation has surpassed market expectations for May on Friday. The rise of the yield is present and seems to keep support for the greenback high, yet at the same time also tumble gold's price, which dropped more than $60 yesterday. Yet we would also like to note the slight yield curve inversion, which worries traders. Should the cautious sentiment be maintained, we may see the USD gaining and US stock markets dropping further. While we will also note the release of the US PPI rates for during today's American session. S&P 500 continued to drop yesterday, testing the S1 3750 support line, yet to seem to have bounced during today's Asian session. We will maintain a bearish outlook for the index as long as it remains below the downward trend line incepted since the 9th of June. Please note that the RSI indicator is below the reading of 30, which underscores the dominance of the bears, yet at the same time also may imply the correction higher is possible. On the other hand, the bounce of the price action during today's Asian session has created some room between the price action and the lower Bollinger Band, providing bears some maneuvering space. Should the bears maintain control over the index, we may see the breaking the S1 3750 support line and aim for the S2 3630 support level. Should the bulls take over, we may see the price action breaking the pre-mentioned downward trend line, the R1 3870 resistance line, and aim for higher grounds. The pound continued to weaken against the USD but also against the euro, in a sign of a broader weakness. The UK growth data for April, which were released yesterday, were a nasty surprise for pound traders as the GDP rate on a month-to-month basis declined further into the negatives, underscoring the shrinking of the UK economy and intensifying market worries. Today we note the release of the UK employment data for the same month, and it should be noted that the UK employment market seems to show signs of tightening as the unemployment rate is expected to tick down and the employment change figure to rise. Should the actual rates and figures meet their respective forecasts, we may see the pound getting some support, yet given the general picture for the UK economy, it remains doubtful. On a fundamental level, we note the tensions with the EU over the Northern Ireland Protocol are rising, and should the tensions actually escalate, we may see the pound retreating as a possible trade war with the EU may be the last thing the UK economy needs. Early in the European session, we get from Sweden the CPI rates for May, while we also know Germany's final HICP rate for May and ZEW indicators for June. On monetary front, we note ECB board member of Schnabel's comments for Euro traders. Oil traders are expecting the release of the US weekly API crude oil inventories figure, and another rise of US oil stocks could weaken their price. In tomorrow's Asian session, we highlight the release of China's industrial output growth rate, and it should be noted that a possible decline deeper into the negatives could have an adverse effect on AUD and vice versa. AUD USD continued to drop yesterday, yet the respected S1 0.6910 support line and bounced higher. We maintain a bearish outlook for the index as long as it remains below the downward trend line incepted since the 9th of June. Please note that the RSI indicator is below the reading of 30, which underscores the dominance of the bears, yet at the same time also may imply that a correction higher is possible. Should the selling interest be maintained, we may see the pair breaking the S1 0.6910 support line and aim for the S2 0.6828 level. Should the pair find fresh buying orders along its path, we may see the pair breaking the pre-mentioned downward trend line, also breaking the R1 0.6970 resistance line and aim for the higher grounds.